Corporate taxation is an area of constant flux, and it plays a crucial role in shaping business strategy, profitability, and long-term investment. Under each new administration, changes to the tax code often reflect the political and economic priorities of the sitting government. The most recent administration has introduced a series of reforms that can significantly affect businesses of all sizes. Whether you're a business owner, an investor, or a tax professional, understanding the intricacies of these new tax changes is vital for planning and decision-making. This video outlines the top 10 things to know about the corporate tax changes under the current administration, helping businesses navigate this evolving landscape. 1. Increase in the corporate tax rate. One of the most discussed changes is the increase in the corporate tax rate. Under the previous administration, the corporate tax rate was reduced to 21%. However, the new administration has proposed raising the rate to 28% to ensure businesses contribute a fair share of revenue to the government. This change aims to fund infrastructure projects, social programs, and other government expenditures. While the exact implementation is still under negotiation, businesses should anticipate higher tax liabilities and prepare for an increase in their overall tax burdens in the near future. 2. Minimum tax on book income for large corporations. To combat tax avoidance, the new administration is introducing a minimum tax on book income for large corporations. This will apply to businesses with profits exceeding $1 billion. Essentially, it ensures that corporations are paying a minimum level of tax based on their financial statements, rather than their taxable income. This change is designed to close loopholes and prevent profitable companies from paying little to no taxes by using deductions, credits, and other strategies to reduce their taxable income. It aims to promote tax fairness and ensure that large corporations contribute more equitably. 3. Changes to the Global Intangible Low-Taxed Income (GILTI). The GILTI tax provision, introduced as part of the 2017 Tax Cuts and Jobs Act (TCJA), taxes the income of U.S. multinational corporations earned abroad at a reduced rate. The new administration has proposed changes to increase the GILTI tax rate from 10.5% to 21%. This adjustment would bring the tax rate more in line with the corporate rate and reduce the incentives for companies to shift profits to low-tax jurisdictions. For multinational companies, this means a potentially higher tax burden on overseas earnings, making international tax planning more complex. 4. Limitations on interest deductions. Interest deductions have long been a popular strategy for businesses to reduce their taxable income. The new administration seeks to limit the deductibility of interest expenses, particularly for large corporations. This is part of a broader push to reduce the tax advantages for companies that are highly leveraged. By restricting interest deductions, the administration hopes to curb excessive borrowing, which could lead to financial instability. Businesses with large debt loads should evaluate their financing strategies and consider the potential impact of this change on their bottom line. 5. Expanded IRS enforcement and audits. As part of the administration's goal to increase government revenue and reduce tax evasion, there is a significant push toward expanding IRS enforcement and audits. This includes hiring additional IRS agents, investing in advanced technology for detecting tax fraud, and increasing scrutiny on high-income earners and large corporations. Businesses can expect more rigorous audits and oversight, especially in areas like international tax compliance, transfer pricing, and deductions. Companies will need to ensure that their tax reporting is accurate and that they comply with all relevant regulations to avoid penalties. 6. Tax credits for clean energy and sustainability investments. Another major shift under the new administration is a focus on encouraging sustainable business practices. The government has expanded tax credits and incentives for clean energy investments, including solar energy, wind power, and electric vehicles. Companies that make investments in sustainable infrastructure or adopt green technologies can benefit from substantial tax breaks. This is part of a broader push to reduce carbon emissions and promote environmental responsibility. Businesses that embrace these incentives may find that they can reduce their overall tax liability while also positioning themselves as leaders in sustainability. 7. Introduction of a wealth tax on high-earning corporations. The administration has also proposed the introduction of a wealth tax aimed at corporations with significant cash reserves or profits. This tax would apply to companies with assets above a certain threshold and could involve taxing a portion of those assets in addition to their regular income tax. This measure is designed to curb wealth concentration and encourage businesses to reinvest profits into economic growth rather than stock buybacks or large cash hoards. Companies with significant reserves should be prepared to evaluate how this new tax may impact their financial strategy. 8. Adjustments to capital gains tax. Although the primary focus has been on corporate tax rates, changes to capital gains taxes will also affect corporations, particularly those with substantial investments or trading activities. The new administration has proposed raising the capital gains tax rate on high earners, which could influence the tax treatment of corporate sales of stocks, bonds, and other assets. While the proposal is still under discussion, businesses should be aware that higher capital gains taxes could impact their strategy for managing investments and capital allocations. 9. Shifts in international tax treatment. The new administration is also looking to overhaul the U.S. tax system's treatment of international profits. For example, changes are being made to how foreign tax credits are applied, with the aim of preventing double taxation on international income. These changes are part of a broader push for global tax reform, which would align U.S. tax policy with international tax standards. For multinational corporations, these adjustments will require careful re-evaluation of global operations and tax planning strategies. 10. Enhanced tax incentives for research and development, R&D. Winking face. The administration has prioritized investment in innovation and technological development. As part of this focus, the government has expanded tax incentives for research and development, R&D. activities. Businesses engaged in R&D can now take advantage of increased credits and deductions for qualifying expenses. This is particularly beneficial for companies in sectors like technology, pharmaceuticals, and manufacturing, where innovation is key to staying competitive. By promoting innovation, the administration hopes to boost economic growth and create high-paying jobs. Corporate tax changes under the new administration have brought both challenges and opportunities for businesses. From higher corporate tax rates to expanded enforcement and sustainability incentives, companies must be proactive in understanding how these shifts will impact their operations, profitability, and tax liabilities. While some changes may increase costs or complicate financial planning, others, such as incentives for green investments and R&D, offer exciting opportunities for businesses to align with evolving market trends. It's crucial for business owners and tax professionals to stay informed about these changes and adjust their strategies accordingly to ensure they remain compliant, competitive, and financially secure.